Okay, we're going to get started. My name is Zacc. I'm the president of Capita Financial Network. I usually give you guys a little bit of an update here. We have 45 employees now. We have 15 financial advisors, and it seems like we're hiring about 2 to 4 financial advisors every year and about 2 people in other roles in addition per financial advisor every year. So that's about 4 to 8 other roles that support, whether that be in HR or operations, investment, trading, and audits, and things like that. So the firm is growing and growing well, and we learned that more than 70% of our new clients and new assets come from either our existing clients adding to their accounts or our existing clients introducing us to a family member or a friend. So that's super exciting for us to hear and to see. And I'm really passionate about what's going on. I have a lot of ideas for the next 12 to 18 months for Capita that should expand our tax services, our estate planning analysis, our investment offering. And so really excited about all those things. I won't go into too much today because we have so much to cover. Today we have Erik, and Erik Soderborg. Sorry, I just know Erik really well. So Erik and I do YouTube together. Erik's channel has gotten millions of views now with, how many are you, 100,000 subscribers now? Yeah, so about 100,000 subscribers, and most of them are people who are really interested in the retirement transition. And so Erik and I have done some YouTube videos, which has been so fun and gotten a lot of really good conversations going. Erik knows a lot about Medicare, so we're having him come in to talk about Advantage versus supplemental plans. And Tim Holland's been here before. Tim is the outsourced chief investment officer at Orion. Orion is very involved in the trading and the rebalancing and the triage process of many portfolio managers down to a menu that we prefer. Lower cost options, lower turnover options, higher quality, meaning the investment managers like companies that have less debt, that have higher earnings, higher history of earnings. Those values in selecting underlying investments align well with what Capita believes. And so we use a lot of Orion's strategies to implement that and the third parties that they give us connections to. So Tim's role is really a big part of that investment committee, and he's going to talk to us and give us an update on markets and what's going on right now. And then in the end, I'm going to talk to you about the Social Security tax torpedo, which is not my term. I wish I made that up. I called it the Social Security tax accelerator, which is not as exciting. But we're going to tell you what happens as you add income when you're in retirement, how that affects your Social Security taxability and how that math works. You don't need to know all the math, but I'm going to show you the levers that you pull that increase your taxable income. And then I'll show you how your Capita advisor helps you through that process and can help you strategize around things. So that's a summary of today. We have a lot to cover. We have these QR codes right here. If you've been to this before, you know that you should scan this because you can put whatever question you want in there, and then everybody else in the room can vote on what question we want to have answered. So scan it, and you can ask anonymously if you want. So that's a really good thing. And you know how it's always hard when somebody kind of asks that question that nobody really wants to talk about? Well, you get to vote it up here or vote it down. So it's up to you guys. We'd love to be able to answer a few questions here. I will watch it, and I'll be able to see which ones everybody's most excited about. And we'll get going on the presentation next. That's Erik first, right? Okay. Sounds great.
All right, it's good to be here. Can everybody hear me? We have different microphones, so I got to make sure that mine's working okay. Turn it down. I'll just have to talk quieter. I don't think I have controls to the volume. As Zacc mentioned, I am on YouTube, and YouTube is a lot less scary than this because if I cough or sneeze or mess up, I can just cut that out, and I can't do that here. But first, I do want to give a round of applause to Shannon and the marketing team. There is so much that goes on behind the scenes to make this happen that we don't see. So if we could give her and the marketing team a round of applause. Thank you. This is a boot camp, and I kind of would like to have a little bit of participation on your end, and that's going to be through clapping and stomping. So just be ready for that. Medicare Fight Night I'm not immune to this. Medicare isn't the sexiest topic in the world. I understand that. It's usually the topic that people want to get through quicker so they can get on to the more exciting things like financial conversations with more handsome presenters. But we're going to do our best here. In the Medicare world, there is a big fight between the Advantage and the supplement conversation. So just with a really quick clap, who here is already on Medicare? Just do a review. Okay, so quite a few. My purpose tonight is not to convince you that you've made the wrong choice or made the right choice for those who are on Medicare. My purpose is not to convince you to go with one or the other if you're not on Medicare yet. I genuinely don't care which one you pick. I'm going to talk about how they work. And this is normally about an hour-long conversation that I've got to condense into about 15 minutes. So if you're here to try and find me saying you're leaving something out, I can promise you will find something that I will leave out just because of time. But here we go. Advantage versus supplement is a lot like the debate between BYU and Utah. And probably more accurate is Democrats versus Republicans. And there is a lot of passion on both sides. I have been called some of the most vile things online because I said something nice about an Advantage plan or I said something nice about a supplement plan. So there's a lot of passion here. And I think specifically politically, there is a problem with original Medicare that an Advantage plan and a supplement plan are trying to solve, and they do it in vastly different ways. Okay, and so the gist of it, and there's more to this, but it's are you okay to pay now, or do you want to pay later? And I'll just take my parents as an example. My dad hates paying for something that he's not going to use. He hates the idea of insurance. He doesn't want to pay monthly premiums if he never goes to the doctor, he only goes for his annual checkups. He hates that. My mom, on the other hand, she has a history of cancer. 28 years ago, she got cancer. She was always afraid of it coming back, and her work would pay for her healthcare premiums after she retired. So being able to pay now with the assurance that she would be okay later was a big deal for her. And so I'll have a story about that here in a minute. Here's the big, messy problem that these are both trying to solve. So these are the holes of original Medicare. If you ever hear original Medicare, that is Part A and Part B. There are a lot of letters in Medicare and it is obnoxious, but original Medicare is Part A and Part B. Part A is your hospital coverage. Think of that as your rent to stay in a hospital or a skilled nursing facility, and it covers a few other things. Part B is your medical coverage, so your doctor visits, labs, x-rays, tests, chemotherapy, things like that fall under Part B. So with those, they have a deductible as a whole. A deductible is the dollar amount you need to pay first before insurance starts to help. If you've had an employer plan, like a high deductible health plan, and it's got a $5,000 deductible, you get to pay the first $5,000, and then insurance says, okay, we'll help after that. So both of these have a deductible. The Part A deductible in 2024 is $1,632. Most deductibles we're used to are an annual deductible. You meet it, and then for the rest of the year, you're done. Not the case with Part A. You can have multiple Part A deductibles in a given year based on certain timing. Part B is an annual deductible. It's $240. That is incredibly reasonable, in my opinion. Once you hit that $240, Medicare, original Medicare Part B will start kicking in. They also have things called cost-sharing mechanisms with copays and coinsurance. Part A, you have copays for daily copays when you're in hospitals and skilled nursing facilities for a certain amount of time. Part B, you have a 20% coinsurance. Now again, if you're used to an employer plan and you have a coinsurance, there's usually a maximum out of pocket where once you hit that number, you're done for the rest of the year. Not the case with original Medicare. So if you have $1 million in claims, which is possible, Medicare will cover 80%. That other 20% is on you. And I don't know about you, but I don't have $200,000 sitting around in that instance to just come up with. So that's part of the problem. And then look at all these other holes. Original Medicare does not cover prescription drugs. It does not cover dental, vision, hearing, long-term care. Think of that as nursing homes, memory care facilities like dementia and Alzheimer's, a lot of home health care. It does not cover care outside the U.S. Excess charges would be if you visit a provider that does not participate with Medicare. And then unapproved charges, Medicare is there for medically necessary things. So if I want to make something bigger or smaller cosmetically, Medicare doesn't care and they're not going to cover that, okay? So there's our big, ugly problem. So I'm going to tackle Advantage plans first. It is Part C, another letter, and alphabetically it comes first. So what a Medicare Advantage plan, this is your pay later concept. 73% of everybody on a Medicare Advantage plan in the country pays $0 in premiums. Okay? You have to have original Medicare to get a Medicare Advantage plan. So Part A and Part B. Part B has a monthly premium, so you still need to pay that. But to have the Advantage plan, you don't have to pay a monthly premium. So that's a positive for that. Medicare Advantage replaces original Medicare, and it is a bundle of benefits. So there's your hospital coverage that replaces Part A. There's your medical coverage that replaces Part B. They usually come with drug coverage, which is Part D, another letter. And they come with other perks like some form of dental, vision, hearing, gym memberships, and other perks that are part of it. But again, this is replacing original Medicare. Usually, if you had a bill, it would go to the government, original Medicare, to pay first, and anything left over goes to you. With an Advantage plan, the bill doesn't even go to original Medicare anymore. It's going to a private insurance company that is going to handle that medical bill. Here are some of the holes that the Advantage plan covers. There's going to be a little check mark on care outside the US, just so you're aware. With an Advantage plan, they will cover a certain amount of emergency care outside the US. It is typically a reimbursement model. So you would pay out of pocket while you're there, and then you submit receipts after the fact, and then they would reimburse you. There are maximums on that, and there are things that you need to understand with that. But that's why there's a little check. But in some form, it covers these holes. Here's the other side of the Advantage plan equation is it is managed care, which is what most of us have been used to our entire lives, but it is a private insurance company handling this. So you are going to have cost sharing whenever you use it. So remember my dad, who hates paying for things he doesn't use, but he's okay to pay for things when he does use it. You'll have copays, you'll have coinsurance. If you go and visit a doctor, you're going to have a copay. If you visit a specialist, you're going to have a copay. If you get surgery, you're going to have a copay. Networks, there are different network varieties here, but in general, going out of network is going to cost you either 100% or more than it would have if you would have stayed in network. Prior authorizations, again, this is managed care, and its aim is to provide the most efficient and effective healthcare at the lowest cost. So as an example, with a prior authorization and a denial, if my knee hurts and I go to my doctor and he says, you should get knee surgery, you might get something from the Advantage plan company saying, have you tried physical therapy first? Have you tried an injection first? So there's kind of steps to that. So you might find prior authorizations and denials with that. And this is kind of a general statement here. I would say that original Medicare has more what I would call kind of auto-approved services than Advantage plans, but in general, that's just something that you'll have to deal with. Now we're going to switch over to the supplement plan side. Supplement plans pay secondary to Medicare. They do not replace it. They supplement it. Okay, so the bill does go to original Medicare to pay first. Whatever's left over then goes over to the supplement plan to pay. And whatever's left over from that goes to you. So it's kind of that intermediary between you and original Medicare and those costs. Medicare supplement plans come in 10 different letters to confuse us even more. So we've talked about Part A, B, C, D. Medicare supplement plans have plans right up there. And in grade school, we were taught that to get an A is the best, right? If I get an A, I'm doing pretty good. If I get an F, I'm not doing so great. Supplement plans are not that way. So the strongest letter up here is Plan F. It's not available to people who became Medicare eligible as of 2020 or later. The next strongest is Plan G. And some of you, I'm sure, are like, oh, I'm sensing a pattern here. K has to be next. You're wrong. It's N. So there's no rhyme or reason to these letters. Just know that they are there. Supplement plan letters are standardized. So if I get a supplement plan G, and by the way, I'm going to be talking about Plan G from here on out. It is by far the most popular. Supplement plan G in Utah with any insurance company covers the same thing as a Plan G with any other insurance company in, say, California or Texas or some other state. So it covers the same thing. They don't cost the same thing between insurance companies. They don't cost the same thing in different states as well. So you do have variety there, but The coverage is the same. Same thing, a Plan N covers the same thing as any other Plan N in another state. These are the holes that a supplement plan fills, specifically G. Notice it doesn't fill the Part B deductible, so you would still pay the $240 Part B deductible. After that, the supplement plan will take care of the rest of Part B approved charges. Does not come with drug coverage, dental, vision, hearing. Similar reimbursement model on outside the US. If you want prescription drug coverage, dental, vision, hearing, you would have to purchase those plans separately. They come with their own monthly premium that you were paying for that. Supplement plans are the pay now version. So the average nationally for a Plan G is $150 per person per month for a 65-year-old. Those rates typically go up a little bit each year. There are other versions, but most supplement plans are age-based. So a 65-year-old pays a little bit less than a 66-year-old. And so we affectionately refer to that as your happy birthday increase. Every time you have a birthday on a supplement plan, you're going to get a little bit of an increase. And then the insurance company does an annual increase every year to account for inflation and rising healthcare costs. So you can see 2 increases per year on supplement plans. And then here are kind of average costs for other drug plans, dental plans, and vision plans here in Utah. The average in Utah for Plan G is just under 150, but it's pretty close. So that just kind of gives you an idea of the monthly cost for an individual. If you're a couple, double those numbers. So here, and I put it as the biggest mistake. I'm in marketing. I got to make things exciting. It's probably not the biggest mistake, but a big mistake people make is they make their decision about these 2 options based on their health at 65 and their finances at 65. And what I'm going to show you is a 20-year look at these plans, because your health at 65 is likely going to be different, and your financial situation, than it will be when you're 85. So let's walk through that a little bit.
Hey, Eric, really quick. We do have a question in here, and maybe before you get into the analysis.
Yeah, let's do it.
Because it has to do with ages. So if I work until age 70, how do I avoid Medicare penalties?
Perfect. Yes. So there are 2 exceptions as to when you do not have to take Medicare at 65 and you will not be penalized. The first is if you are actively working and you're covered by a group health plan through your work. Okay. The second is if your spouse is actively working and you're covered by your spouse's plan through work. Okay. So if either of those apply to you, you do not have to take Medicare at 65. You will not have a penalty. Does that help?
It just, for a lot of people, it's really scary because they get all those mailers, right? And tells them they have to sign up or they'll be penalized forever. And a lot of people work beyond 65 and have group coverage. So it's something to be aware of for sure.
Yeah.
And then when they go, just also a quick update, but when they go to apply for Medicare, usually there's a form to be filled out, signed by your HR team saying you've had coverage, so you're good to go.
Your employer fills out that form. They just say, yes, they were covered by our plan and you're good. Yeah, that is a big thing that scares a lot of people. And I get a lot of fighting on that online because they heard their HR person told them they have to go on. And just a fun fact for everybody, if your company has 20 or more employees, they cannot force or encourage you off of the plan and onto Medicare. What do I mean by encourage? They cannot say, hey, if you get off of our plan and go to Medicare, we will raise your salary by the same amount. So they can't do that. So if your employer is doing that, then tell them to stop it. For those who have already gone through this Medicare process, or if you are 64 years old, what Zacc said, your mailbox is going to blow up, your phone is going to blow up, your email is going to blow up. There's not a lot you can do about it. So all of the programs that we sign up for free, whether that's social media or anything else, people know what your birthday is. And those evil marketers can buy lists of people who are turning 65 in the next year. And then you get this deluge of mail into your mailbox. Just throw it in the recycle bin. All right, let's look at the 20-year costs here. So supplement plan G, let's see, there was a pointer. Ooh, here we go. So there's that $150 average premium that I was talking about. We're seeing about a 7% growth rate per year on these premiums. So we come down here, and once you're 84, $542 a month-ish for your supplement plan G premium now. Over here is the Part B deductible. Over the last 20 years, we've seen a 6% growth rate in that every year. Here I have you're meeting 10%, 50%, and 100% of your Part B deductible, and that repeats every 3 years. It's probably not realistic, but and by the way, I'll have this calculator available for everybody. They'll send it to you, and you can put in your own numbers. You can put in whatever you want for these in the blue parts. There's your drug plan premium that goes up by about 6%. That's longer than I have time for. Part B premium is about $175. That's the base premium. If you're making higher income, that can be higher. That growth rate is about 6%. And then your dental premium with a growth rate of 4%. So down here is the total. So over the course of 20 years, call it $185,000 for an individual, double that if you're a couple, that you need to have in financial assets to cover your Medicare healthcare costs. Now, a lot of your Part B premiums can be paid through Social Security, so that's one way to deal with it. But that's a sizable amount of money. And the real bummer with supplement plans, in my opinion, is when it comes to health savings accounts. So if any of you have an HSA, a Medicare supplement plan premium is not a qualified medical expense. So you can't use your HSA to pay for supplement plan premiums without a penalty. I think it's a silly rule. I don't support it, but they don't care what I think about it. So that's where that amount of money you would have to have in other assets to take care of it. Let's switch over to the Advantage Plan side. We'll see that the chart is cleaned up a little bit because most don't have a premium. Most aren't paying a Part D premium either. In Utah, the maximum out-of-pocket is around $5,500. There are plans that are higher, plans that are lower. So that's that max out-of-pocket of where once you meet it, the insurance plan takes care of the rest. And then you still have your Part B premiums with the same growth rate here. So down here, we're down to $153,000 for an individual, $305,000 for a couple. The wrinkle here is that if you have a sizable HSA, all of it can be used for those. So there aren't any restrictions on whether if you did have a premium with an Advantage plan, you could use your HSA dollars for that. You can use it for the max out-of-pockets, co-pays, co-insurance, Part D, everything. So financially, let's take a look at this. Again, I am not trying to convince you one way or another, and I'll get to this. In this situation, with these variables that I put in, again, you can go and change those. The supplement plan is about $32,000 more expensive for an individual. So as we go through who kind of gravitates to these, I'm going to come over here for my dad. My dad hates paying for things he's not using. He wants the low premiums, he wants drug coverage included, and he wants the other perks. He has a gym membership. He likes reimbursing things for fitness, other things like that. He absolutely loves it. My mom wanted the freedom of a network. She had her cancer doctor 28 years ago. She wanted to make sure that she could use him no matter what. Once she had a bill, she didn't want to have to worry about anything other than the Part B deductible. And she didn't want to worry about prior authorizations or denials. And so for some people, that cost difference is enough. The cost difference, the additional dollars from a supplement plan is enough. And that's completely okay. Here is the most important takeaway, and this one is legitimately the most important takeaway. This isn't me just messing around here. You do not have to make this decision on your own. This gets completely overwhelming. I've got 200 videos on YouTube, and you can do a deep dive all you want. There are DIY mentalities, and I get that, but you do not have to do this on your own. Sharing an office with Capita is a group. We've got another Medicare agent, great person here as well, that can help with this. And I want to end with a story. So as I've mentioned with my mom, she had a prior history of cancer. She would go to lunch every other week with her friends, and they would talk about family. They would talk about their kids and grandkids, their friends. And believe it or not, they would talk about Medicare over lunch. And so I got a call from my mom one day, and she said, "Eric, why didn't you put me on the same plan as Carolyn? Carolyn has a free gym membership." And I said, "Mom, when is the last time you went to the gym?" And she said, "Never." And so I said, "Okay." And I went through a similar conversation that we've just had. We have a video on YouTube that I sent her as well that's a half hour long, goes into a lot more detail. She sent me a text after she watched that and she said, "You know what? I'm on the right plan. Thank you." We also helped her friend Carolyn with Medicare, and our group, after our help, she chose to go with an Advantage plan. And so she called me and said, "Eric, why didn't you guys put me on the same plan as your mom?" I said, "Carolyn, does your work pay for all of your monthly premiums for your healthcare after you've retired? No. Carolyn, do you have a history of cancer or are you afraid of it? No. Carolyn, can you and your husband afford the monthly premiums of the supplement plan? No. That's why. So 4 months after that conversation happens, cancer comes back from my mom. I'm going to try and get through this. Yesterday was Mother's Day, and it was my first Mother's Day without my mom. So cancer came back, and after 10 months, she had $709,000 in medical bills that came through in just those 10 months. She was on a supplement plan. Our family paid $240 for that Part B deductible and the monthly premiums for her plan. Now, on an Advantage plan, she would not have paid $709,000. It would have been around $8,000. Supplement plan was around $4,000 with premiums and everything included. But had she made that decision because she was talking to her friend and she wanted the same plan that her friend had because of a free gym membership, that would have completely changed her interaction with the healthcare system. It would have completely changed my interaction with the healthcare system because I was in charge of her medical bills. So the point is, do not rely on the advice of your friends. Do not rely on your advice of your siblings or your neighbors when it comes to Medicare decisions. If you're working with an agent, and it sounds like a lot of you are already on Medicare, if you're connected with Capita, you probably know either Katrina or the people over at Senior Benefits Insurance Services. They are unbelievable. Please rely on them before you rely on your friends or even your spouse or me. And so here's where you can find me, theretirementnerds.com. I'm on YouTube as well, where I take deep dives into all of these topics. There's a $47,000 ER bill, how it would be covered by each plan, when not to take Medicare at 65, which Zacc covered. So thank you for taking the time. Now you can get on to the more attractive presenters and the more fun topics.
Eric, we have one question.
Sure.
Another question in here. So once you're on one plan, can you switch to another?
Yeah, so it depends is going to be the answer pretty much always for Medicare. There in Utah, we have a unique situation. So to go to an Advantage plan is pretty simple. Going to an Advantage plan is pretty simple from a supplement plan. During the annual enrollment period, which is October to December, you can make that switch. Going from an Advantage plan back to a supplement plan gets a little bit tricky. It depends on timing. So if you go on Medicare at 65 and you take an Advantage plan, you have a year to try it, and then you can jump onto a supplement plan with no medical questions. If you start on a supplement plan and then you switch to an Advantage plan, you have a year to try it out. And if you don't like it, you can go back to the same supplement plan you had. If you're outside of that and you're on an Advantage plan and you want to switch back to a supplement plan, you would have to go through medical underwriting. So they're going to ask you health questions. They're going to ask your health history. And there is a chance that you will either be denied or they will raise your rates. They can charge you more than they would otherwise based on your age. Other states have other rules around that, but in general, that's kind of what you're looking at for switching. Good.
Thanks, Eric.
Got to make sure to turn the mic off.
Some things.
Thank you, Eric, for sharing that about your mom. So I've known Eric through this process and watched him handle it incredibly well. But thank you for sharing that with us and sharing us all that about Medicare. You're up.
All right, thanks. Thanks, Zacc, and everyone at Capita for the chance to be here tonight. Eric, that was super informative and very sorry for your loss. That's really tough. I'm just going to spend 15 minutes. We're going to talk about 4 topics in this presentation where we're calling it on the other side. If you pay attention to Wall Street and the markets, the last couple of years have really been about 2 things, inflation and interest rates. So we're going to spend some time looking at what the world should look like now that the Fed is done raising and hopefully cutting. But there's a lot of debate around that. You know, when does Jay Powell and the Fed move from just sort of sitting on their hands to actually lowering interest rates? And those expectations, as you may know, have been all over the place the last couple of months because inflation is coming a little bit hotter than expected of late. And if memory serves, this Wednesday, we'll get the consumer price index for the month of April. So all folks on Wall Street are going to be paying attention to that data point. So if you're really interested in this, Wednesday is a big a big day from a news perspective. We're going to talk about 4 things in particular, including that sort of on the other side of the interest rate hiking cycle. The first is our stocks in a bubble. The S&P is up about 10% year to date. It's less than 1% away from its all-time high after being up 20% plus last year. So lots of folks think we've come too far too fast. We don't think so, but we'll talk about that. Again, talking about, what does the world look like once the Fed is done raising and then hopefully pivoting to cutting. Why hasn't the economy cracked? I live on the East Coast, but I'm in Utah about once or twice a month. Clearly, this state's been booming the last couple of years in particular, but there's lots of smart people, smarter than me, wondering how the economy can continue to do as well, considering the Fed's taking rates from 0 to 5.5%, and people are paying more at the pump and at the grocery store and for credit card debt and so on. So we're going to talk about that. And then domestic and global politics. I'm not breaking any news when I say we have an election coming up. It's probably going to be the most contentious in the last 100 years or so. And you've got a geopolitical backdrop that's beyond unsettled as well. So I'll try and get through all that in 10 or 15 minutes. To Zacc's point, if anyone has any questions, fire away and we'll do our best to answer. Okay, so our stocks in a bubble, we don't think so. So I won't list out all the characteristics of a bubble, but if history doesn't repeat on Wall Street, it certainly rhymes. And these are the characteristics that tend to present themselves when we've entered silly season. And I think it transcends the asset class, meaning meteoric rise in prices, a disregard for fundamentals, and the price you pay doesn't matter. Could apply to housing 15 years ago or stocks 25 years ago for those of us who are investing in the late 90s, or for you historians or folks that are interested in economic history, tulip mania of the 1640s, right? Arguably the biggest bubble of all time. If you've never read about it, it's fascinating. But apparently the Dutch went nuts for tulip bulbs, which I think is kind of funny because I would think there's a ton of tulip bulbs in Holland, but maybe there was a limited supply. And if history's anywhere near accurate, at the peak, one tulip bulb could buy you a mansion in downtown Amsterdam. And then it all went away. So it really doesn't matter if it's stocks or real estate or flowers. This is kind of what you see. People just go nuts. And so we get this question a lot, considering how well markets have done, especially call it the last 15, 16 months. And we would say no. And we're just going to talk about a couple characteristics that tend to present themselves at a bubble peak or before the bubble's about to pop, and why we don't think that's the case today. So the first would be sentiment. When you're near the end of a bubble, everyone's all in. People are flipping houses in 2005 that have no business flipping houses, or people day trading in 1999 who have no business day trading. So the upper left of this screen just plots out a very well-regarded sentiment survey. And when that blue line gets towards the top, it means a lot of people are optimistic. And when it gets towards the bottom, it means a lot of people are pessimistic about the market. Warren Buffett famously says, be fearful when others are greedy and greedy when others are fearful. So if you look on the left-hand side of that graph, you'll see where we got in the late 90s, right? I was living and working in New York City at the time, and it was just a mania in terms of the market and tech stocks in particular. The other thing I'd point out is the You've Got Mail movie poster. Some of you may remember that movie, right? It reunited Meg Ryan and Tom Hanks, who are awesome in Sleepless in Seattle. And it was a romantic comedy, but I'd argue it was as much about AOL and online communication as it was about Meg Ryan and Tom Hanks and those sparks flying between those two great actors. So the point I'm trying to make there is when an asset class so pervades the culture that they're making movies around it, you probably want to lean the other way. And I'd argue that's not the case today. The other anecdote from that movie
Tim,
is,
can I ask a quick question? Because we've got some people wondering, some of these questions I'm going to sprinkle them in at the right time, but this one's needed. What does stocks in a bubble mean?
Yeah.
Define a bubble.
Yeah. So a bubble for any asset class, stocks, real estate, or again, tulip bulbs, is when the price people are willing to pay makes no sense relative to the underlying value of the business. Right? So, and we've got another example, a couple charts or a couple slides in, but it's when you're just willing to buy a stock because it's been going up. And you just assume it's going to continue to go up, and it doesn't matter to you that the company's not profitable. or the price to earnings multiple, the valuation of the stock makes no sense whatsoever. And maybe the greatest example of that, again, back to real estate. So we all remember 07 and 06, right? And it wasn't just residential real estate, but it was commercial real estate. And there was a very famous real estate investor, Sam Zell, who recently passed away, from Chicago. Southside Chicago, the son of immigrants. Parents came over from Eastern Europe, dirt poor, and he bootstraps himself into one of the most successful real estate investors of all time. Owned half of downtown Chicago and commercial properties all over the country. And he sells out to this massive private equity firm in 2007, right? Just as the air is about to go out of the real estate bubble. And I'll never forget this. I read an interview with him, and I didn't know him, but I admired his business acumen. And he was wealthy. He didn't need the money. He was already, extravagantly wealthy. And they said, Sam, why did you sell to Blackstone? And I love this answer. And it gets back to, in my opinion, sort of, this is a better answer for what is a bubble. He said, because someone made me an offer that made absolutely no sense to me. And he took their check and they took their real estate and they overpaid by a factor of 2 or 3. And he walked away with the money. And then to his credit, it came back 5 or 6 years later and started buying those properties back on the cheap. So that's a bubble, in my opinion, when the value of the asset is completely disconnected from the fundamentals, the profitability, and what that company or that real estate should do for you over time, if that's helpful. Okay, and the other anecdote for that movie, when the shop around the corner, Meg Ryan's bookstore, was closing down, Gene Stapleton, who played Archie Bunker's wife on All in the Family, right? Remember Meathead? I used to love that show. Not that, I was alive, but I caught it more on, I did catch it in the late 70s. She's working for Meg Ryan. This probably choked my entire 20 minutes. And they have to close the store, and Meg Ryan feels really bad. And Gene Stapleton says to her over tea, don't worry about me. I bought Intel at 6. So if you're watching a TV show or a movie and that happens, you're in the latter stages of a bubble. My apologies. Okay, so that's the first thing. Sentiment just gets goofy. People go all in on an asset class. So again, if you think of the late 90s, day trading, you may remember that. Real estate, people buying 2 or 3 homes who didn't really know what they were doing. If you look on the right, it's just a plotting out of mutual fund and exchange traded fund buys and sells over the last 7 or 8 years. And when that line's below 0, it means people are net sellers. When it's above 0, people are net buyers. For the last 7 years or so, the average American investor, us, has been a net seller of U.S. stocks. And they've missed out on some phenomenal returns. Now, some of that's demographics, good financial planning. I think a lot of it is just people being burned through 08, 09, and then the pandemic as well. So it's another way of saying it doesn't seem like people are all in on stocks, at least in our opinion. And again, when everyone goes in one direction, you want to go in the other direction. Wall Street's behaving itself. So IPO, as you probably know, is an acronym for initial public offering. It's when a company becomes public, when it decides to list on a stock exchange and take the public's capital in return for being a publicly traded company. If you look on the left or center left, that's how many IPOs there were in the late 90s, right? And if you look on the far right, that's how many IPOs are taking place today. So when you see everyone, including founders, rushing for an exit and willing to give away their company for your money, at that level, again, something's not exactly right. And again, living in New York City in the late 90s and working in this industry, I remember all you had to do was put .com at the end of your company and you could go public. So you might remember pets.com, remember the sock puppet, toys.com, all of those .com companies, most of them didn't make it. So when the bankers start going crazy, something's probably not right too. This is, for me, the poster child of IPO excess. It was a company called theglobe.com, went public in 1998. Think of it as an internet platform or chat room company. The stock went up 600% the first day it was traded. That just makes no sense. No company is worth 600% more on a Tuesday than it was on a Monday, and then they were out of business 2 years later. So when you see that kind of stuff and that kind of media, you probably want to move on. Finally, valuation on the left-hand side, that blue line is what tech stocks were trading at 25 years ago. So you hear PE, price to earnings, multiple. It's the most common, most widely accepted form of valuing what a company might be worth and whether or not it's a good bargain or not, inexpensive or expensive. 25 years ago, technology stocks were trading at 60 times earnings. Today, they're trading around 31, 32. So 31, 32 is expensive for sure. It's not 60. So if you think about sentiment, valuation, what Wall Street is doing, if history is any guide, it gives you a pretty good idea where we are in the cycle. So I'll stop there. Any other questions about market bubbles? Yeah.
Okay, so are federal policies such as tariffs and discouraging international commerce keeping inflation high?
They will if they're not already, yeah. So I know the Biden administration is going to come out and talk about, I think, 4 times tariffs on EV vehicles and some other products from China in particular. But yeah, tariffs are inflationary. So you're absolutely right, whoever asked that question. Anything that sort of gums up the works is going to push prices higher. So if you think about, now there could be very good reasons for doing that from a national security perspective, from a supply chain perspective. I'm not saying it's not a price worth paying, but if you think about President Trump and the tariffs he put in place, and the Biden administration has continued all of them. You know, I'm telling you all stuff you already know, but if there's one thing that seems to unite Republicans and Democrats in DC, it's that we were asleep at the wheel with China, and that's got to stop. So it looks like the administration is going to come out with a new set of tariffs as well. So you go through the pandemic, we realize that these supply chains are beyond our reach, beyond our control. We can't get access to goods that we thought we could. And so there's been this big push from a national security perspective to onshore or reshore, they call it. Bring those production facilities or assets either back to the States or to Mexico, Canada, or more friendly nations in that part of the world, including Vietnam. So that's an ongoing process. It's going to play out over a very long period of time. And it is inflationary because a worker in Mexico is probably going to make more than a worker in China. And to that end, it's interesting. Last year, based on trade settlement data, was the first year that we imported more goods from Mexico than China in over 20 years. So a lot of that has already played out, and I would expect it to continue regardless of who wins the White House, President Biden or President Trump.
Jim, wouldn't you expect too that as those tariffs create, as you said, gum up the system, there's a lag between that decision and the actual implementation of even the higher cost labor somewhere else, right? Yeah. So not just the trading of a higher cost labor, but the lack of supply while we get that whole situation reworked through a different channel, right?
Yeah, and even if the company that's making that decision pulls it off perfectly, where they keep a legacy supply chain in place and stand up another one in parallel, you're now doubling your costs, right? So that company either has to pay for that out of its own profits or raise prices to offset some of the additional. So there's no free lunch on that front for sure. And I do think that's going to continue just because our relationship with China, Western Europe's relationship with China is in a completely different place than it was where it was 10 years ago. And again, I don't think that's going to change anytime soon.
So the next question is probably more of a financial planning question. So I'll make you answer.
Yeah.
So it's how much do interest rates need to drop before looking into refinancing a home equity line of credit? So that's very personal because the first question is, what is your rate? Normally a HELOC is variable. So what is your variable rate on your HELOC? Are you trying to refinance that to a fixed rate? Are you trying to just look for a better variable rate? Are you trying to refinance your primary mortgage that then incurs costs? So there's a lot of components to that question in particular that also impacts your cash flow. How does that impact your actual inflows and outflows, meaning your income or your expense? Anyway, so that one's probably harder to answer given that it's much more specific. But most of the time, if you're just talking about refinancing your mortgage, usually you need to see at least 0.5% or 1% or more of an improvement to make up the costs of the transaction within 2 minutes. You don't want to have to wait for 15 years to make all that back. You want to try to make it back within 5. That's usually my goal. If you could get it back within 5 and the costs can be made back within less than 5 years, that seems pretty reasonable to do that. Okay.
All right. So what do markets look like in a post-rate hiking world? We're already in a post-rate hiking world. I should probably change the cover slide or the title slide. So the Fed last raised rates in July of last year. So we're coming up on the 1-year anniversary, right? They went really hard from March of 2022 to July 2023. It took the Fed funds rate from 0 to 5.5%. So the big question is, when are they going to cut rates? And no one knows, right? Because the Fed is a data-dependent institution, which can get a little tricky because the data can change very quickly. But coming into the year, Wall Street thought the Fed would cut rates 6 times, from 5.5% to somewhere in the mid-4s, which didn't make sense to us because that would speak to an economy that's really in pretty tough shape. The Fed was guiding to 3 cuts. Then we got 3 months in a row of hotter than expected inflation data, and the market expected no cuts. Then a week ago Friday, we got a jobs report for April that was disappointing, and now the market's thinking 2 cuts. So I could kind of go back and forth like I'm watching a tennis match, but I guess the point I'm trying to make is, the Fed is going to look at inflation and employment in particular. They don't want to wait too long because high rates do impact the economy. It takes a while, but they don't want to cut rates and then have to go back and raise them again. That's the last thing they want to do from a credibility perspective. But right now, Wall Street at least expects 2 rate cuts this year, and the Fed will tell us in about a month or so what their updated expectations are for 2024. We think they're going to end up cutting a couple times because we do think some of the data is going to come in a little softer than expected. But this is what everyone on Wall Street's paying attention to, and it's really because markets love cheap money, right? Consumers like lower cost of capital, so do stock investors and so do companies. So the good news is, if you look back over the last 40 years or so, whenever the Fed has finished raising rates and you look forward 6 or 12 months, stocks are up nicely, and that's what's happened again so far. So we're about 10 months into this, and the U.S. equities are up about 17% now. And that's because, again, on balance, lower interest rates just make stocks look more attractive relative to bonds, and they make those company earnings worth more when you try and figure out what a company's worth. So stocks do well and bonds do well. This is just a plotting out of the Bloomberg aggregate. It's the S&P 500 for bonds, so think of it that way. And usually bonds do really well when the Fed is done raising rates, because if you think about it, if the Fed is cutting rates, every bond that's going to come to market after the Fed cuts is going to have a lower yield, right? Because interest rates have come down, which means every bond that's already trading with a higher yield is going to be worth more. And the inverse is true. 2022 was really bad for high quality fixed income, even because the Fed was raising rates so much. The beauty about fixed income and owning individual bonds is you can ignore bond indices and the market and prices, because if you own a bond from a municipality in the great state of Utah or the U.S. government, and you're not worried about them making coupon and principal payments, you can ignore the price of the bond as interest rates drive prices up and down, if that makes sense. But bond markets in particular do well once the Fed starts to cut. Let's see, in terms of the market itself, you probably have followed the Magnificent Seven, right? NVIDIA and Meta and Microsoft and Amazon. They did most of the heavy lifting last year for the US market. What's encouraging is not all 7 of those stocks are doing well this year, but the S&P is still up 10%. So for folks in our business, you like to see more companies pushing the market up and not just see a big index like the S&P dependent on a handful of companies to push it higher. And small companies have done really well since last year. That's plotted out on the right-hand side. We already talked about this. In the first quarter of the year, every sector in the S&P was positive, except for real estate. Real estate doesn't do well when bond yields go up because it's a levered asset class, right? So if rates start to come in and yields start to come in, interest rates will become much more favorable for real estate. You should see a nice pop in prices. But again, the market, even with the volatility in April, is off to a great start, and it's not just a handful of stocks doing the heavy lifting, if that makes sense. Ultimately, the markets care about 2 things, at least in our opinion: earnings and interest rates. So on the left-hand side is just a plotting out of the earnings produced by the companies that make up the S&P 500. We're finishing up Q1 earnings season right now. Most companies are on a calendar year, and earnings are going to grow mid to high single digits and probably grow high single digits for the year. And then on the right-hand side, we plot out the yield on the US 10-year note. It hit over 5% in October of last year. Stocks sold off, and then it fell to under 4%, and stocks ripped. And then a couple weeks ago, got back up to 4.7%, and stocks went down in April. And then we got that jobs report that showed the economy was maybe weakening, and yields came in. So ultimately, if yields are moving sideways to lower and earnings are moving sideways to up, even with the unsettled world we're living in and an election coming up, it's a pretty good backdrop for U.S. equities. And we're overweight U.S. equities. Okay. Why hasn't the economy cracked yet? The resiliency of the U.S. economy always astounds me, no matter how many books I read on economic history, how much I try and pay attention to what's going on today. So as a rule, I do not like to bet against the U.S. economy. I do not bet against the U.S. consumer. And if you look at economic history, we're only in recession about 10% of the time. And markets go up about 80% of the time. So I like to lean into that optimistic worldview, partly because history tells me it's a better way to think about the markets and the economy. But I thought the economy would be a lot weaker by this point, considering that the Fed took rates to 5.5%. I know what credit card interest rates are, what home mortgages are costing people, and what inflation has done. But the economy has proven remarkably resilient, and folks that are a lot smarter than me are as surprised as I am. So a couple things. Consumers are still spending money. Right on the left-hand side, we plot out retail sales. The April number surprised to the upside. So the U.S. consumer's hanging in there, partly because of all the money that the government pushed out during the pandemic. Took a little bit longer to get spent down than people thought. And then the other big reason is just the jobs market. Right? The unemployment rate is still sub 4%. We added over 2.5 million jobs last year. And if you go back to the first 3 months of this year, markets got off to a great start. The S&P was up about 11% through the first quarter, but we got a hotter than expected consumer price index report in January, February, and March. And then markets finally started to roll over in April. The S&P was off over 4% because folks in my business started to think, well, you know, maybe the economy's running even hotter than expected. The Fed's not done raising rates, so on and so forth. And then we got a jobs report that showed only 175,000 jobs were created in April, and the unemployment rate ticked up to 3.9%. So we could be at an inflection point for the jobs market. I don't want to see people lose their jobs. Unemployment's a terrible burden for anyone to bear. But that's why the economy has been so strong, because the consumer's been good, because labor markets have been good. But we could be at a point where that's starting to weaken. But this is ultimately what drives our economy, all of us, the U.S. consumer. So if the jobs market's okay, the consumer is going to be okay. And then you have immigration. Just trying to understand why the economy has been so resilient in the face of an historically aggressive Fed. A lot of folks think this has been a big part of it. So not to get into politics of this, and I honestly think this is something that economists are going to spend decades trying to figure out. But most folks think anywhere from 8 to 12 million people have entered the country over the last 4 years, most crossing the border illegally, and then most just making their way to other parts of the country, and many of them joining the labor force. So if you think about last year when we were adding 250,000 jobs per month, but wage inflation was coming in, which is a great thing if you're a company because you want people to get some raises, but not too much, because there goes inflation and profits. A lot of people think it's because an expanding labor force, and that immigration's a big part of that. So that, I think, has helped mitigate both the inflationary pressures a little bit, but also keep the economy going because there were people to take those jobs. And we're more productive. Labor productivity is plotted out on the left. How many Americans are working is plotted out on the right. Right during the pandemic, nobody wanted to go to work because they didn't feel safe, or they didn't have daycare. And then finally things started to get back to normal. So people have come back to the workforce. That's good. And we're being more productive. And ultimately you need, ultimately you need two things to grow an economy: people and productivity. So on the left-hand side, productivity has gone up 2.5% over the last 6 months. If you annualize it, that may not seem like a lot, but that's an astronomical jump in productivity. And that's pre-AI. So no one's really sure why, but if you want to be optimistic about the economy and productivity and corporate profits and the markets and the U.S.'s ability to continue to be the world's largest, most important economy, productivity is a huge part of that. And AI, which is just getting started, artificial intelligence, could be a huge part of that. Talking about refi. So the Fed raises rates to 5.5% and the consumer doesn't bat an eye. And it's probably because so many people refied their mortgages when the Fed took rates to 0. So chief financial officers, CFOs across the country refied their balance sheets, and folks like us refied their mortgages. So it doesn't matter that the Fed's taking rates to 5.5% because we've got something locked in for 30 years at 3, right? And my wife Meredith and I refied our house in 2022, and I'm not the smartest guy in the room, but if Wells Fargo is willing to lend me money for 30 years at 3%, I'm going to take it. Right. And so that's why a lot of people think, even though the Fed's been so aggressive, the economy hasn't slowed yet, because people have locked in really attractive borrowing costs tied to their most important asset, which is their home. We're wealthier than we've ever been. Markets at all-time highs. Home prices are all-time highs. If you own your house outright and you have meaningful equity exposure, even with all the craziness of the last 15, 20 years, it's been a pretty good time to own real assets, either real estate or stocks and bonds. And that makes people feel wealthier because they are wealthier, and then they tend to spend a little more money. And our government's spending money hand over fist. We're going to run a deficit this fiscal year that's about 7% of GDP. We usually only do that during a pandemic or war or a severe recession. None of those things are going on right now, but no one seems to really care. And so everything that Jay Powell and the Fed is doing to kind of slow the economy down by making all of us pay more in interest rates, the federal government, to a certain extent, is offsetting that by pushing a tremendous amount of money into the economy.
Tim, there's a question specifically on that.
Yeah.
Can we continue to ignore the national debt, or might we expect an action that might affect the market, and what might that be?
Yeah, that's a great, and if I'm running too long, let me know.
No, if they have questions, this is what we want.
Okay, so I would get asked about the deficit and the debt whenever I would talk the last 5, 10, 15 years. And not to be flip about it, but up until the pandemic, if someone would ask me, when is the debt going to matter? And I would say, I don't know. And if anyone tells you they know, they're lying to you, right? They just don't know when the bond market may scream enough, or people that put money into our country will decide to go somewhere else. And I would say that because countries like Japan and Italy have a lot more debt than we do, smaller economies, and they're a lot older than we are. But I do think we're at a point now, because of higher interest rates, where we can't ignore this. And what I mean by that is a 10-year yield at 4.5%. Essentially, the federal government's got to pay 4.5% to you or me every year for 10 years for us to loan them money. When the Fed took rates to zero, that was 0.5%, and 15 years ago it was 1 to 2%. So our borrowing costs have gone up a lot. And you probably know this, but because of all the money we put on the country's credit card through the pandemic, through both administrations and both parties in Congress, we did that, and then interest rates shot up. So we're now spending as much on interest expense as we are on the U.S. military. And that, to my mind, is not sustainable, right? So if you think about the government's budget, and Eric, I'm sure Eric knows this much better than I do. You've got Social Security, Medicare, Medicaid. You've got military spending, interest expense on outstanding debt, and then a little bit left over for everything else. So I think something's got to get done. For now, the bond market's not holding politicians' feet to the fire. My best guess is either, and this is probably way too optimistic, you get through this election and there's some sort of bipartisan work around trying to minimize growth in spending and try and get the deficit and the debt under control. And I think if we don't, that at some point the bond market's just going to demand an even higher rate of interest, and that's going to force the government to take some action. So I still don't know, but I think we're at a point, especially because of annual outlays, where we can't ignore it anymore.
And the higher rate at which new issues are done is your thought as to why the government can no longer, or why at some point soon they will have to pay more attention to their spending.
I don't think yields are. Yeah, so I think the government and the markets are okay with the 10-year around 4.5%. I think anything above 5, the bond market probably starts to do, which is what it did last year, which is sell off meaningfully. So the market seems okay with where we are right now. But I would think if we don't either do something proactively, or at least just kind of move sideways in terms of spending and taxes, that the bond market's just going to say enough. They're not going to take all the supply that we continue to issue. They're just going to say, no more.
So paint that picture, because a lot of our clients will hear you say that and say, that means collapse.
Yeah. No, it doesn't mean, it doesn't mean, so this is going to sound silly, right? But this big blue marble is going to keep spinning no matter what the folks in DC do, right? And this country and this economy of ours, at least for our collective lifetime, is going to remain the world's most important. I mean, there's nothing on the horizon that's going to knock the U.S. out of its seat because we live in a relative world, right? If you're not going to own U.S. stocks, you have to own Japanese stocks or gold or Bitcoin. You have to own something, right? So higher borrowing costs for a government doesn't pretend economic collapse or runaway inflation or sort of economic chaos. What it portends is Wall Street sort of collectively, globally, pension plans, insurance companies, large hedge funds, demanding a rate of interest that becomes unsustainable for the government. The government's forced to raise taxes or cut spending. And there's a self-correcting mechanism built in. You saw it in the early 80s, right? In late 70s, when inflation was going through the roof. Paul Volcker came in and took interest rates to the high teens, put us into a terrible recession, a double dip recession that broke back inflation and started a 40-year bull market in bonds and gradually lowered borrowing costs, because our spending, and the deficit slowly became much more manageable as a percentage of GDP.
Which is super hard because on the backbone of that, you've already talked about, you've got interest rates being at a reasonable borrowing cost for corporations and 10% year over year increase in their corporate profits, which are two of the biggest drivers, the highest correlation to stock prices going up. Yeah. And so this is why it's so complicated and why we get so many mixed messages, because on one hand, you've got really healthy environment for employment, for interest rates, and for profits. Yeah. But yeah, the government debt is tricky, but I think a lot of our clients won't have to deal with it during their lifetimes. I think it's something that the generation beneath me even is going to be feeling it. Yeah. You're not beneath me.
I think you're right. And I don't, who knows what's going to happen come November, but even if you just kind of went sideways in terms of tax rates and spending, the economy grows at 1% to 2% per annum on a $30 trillion number. Tax receipts go up. GDP increases, debt to GDP comes down. So a lot of this can be solved for if you just don't increase spending for a couple of years. And if you just leave tax rates as they are, it doesn't take a ton. The other thing is a recession would help to a certain extent, right? Because a recession would mean negative GDP. It would open the Fed to cut rates. Bond yields would plummet and our borrowing costs would go down dramatically. And I don't think anyone would want to root for a recession. I think something mild's coming for the real economy. I think Wall Street's going to be fine. But if we did get a downturn in the economy, that would pull in yields and make it a lot easier for the government to finance its debt. But with all of our problems and the amount of money we've borrowed and the amount of money we're spending, and again, this may be too optimistic, it is a relative world. And so capital and people, in my opinion, are going to go where they're best treated. And capital, you have Wall Street, the original 187 and the sequel, which I didn't think was as good, it just moves at the push of a button, right? And so capital and people will go where they're best treated. If you think about our economy, our markets, money continues to flow into the U.S. And unless we really mess this up, that's not going to change. What's going to be variable is the level of interest that bond markets demand. So,
can I ask one more question, and then maybe we'll jump as soon as we can to the next topic here. What will be the impact of the large baby boom generation getting older and the drop in birth rate?
Yeah. So, there's a great article in the Wall Street Journal today, co-authored by Greg Ip, which is about global demographics, right? And I'm an optimist. I like to joke, even though I grew up in New Jersey, I'm an optimist. It's not easy coming out of Jersey, being an optimist. A lot of therapy, a lot of self-help books. But if there's one thing that I really think about and I worry about, it's demographics. And we're having fewer babies. And it's not just here in the U.S., it's all around the world. And it's even in parts of the globe where birth rates were still very high relative to developed markets. And even those are plummeting. Sub-Saharan Africa in particular. Mexico is already gone. Brazil's already gone. Most of Southeast Asia. So again, the Wall Street Journal today, brilliant article. There's another book called Empty Planet, a play on the travel books, Lonely Planet. I could talk about this for forever. I won't. But the basic idea is any woman of childbearing age has to have 2.1 kids to keep at least population static, right? Because unfortunately, not every child makes it through childbirth or through infancy. And so that's a replacement rate, 2.1. The U.S. was above 2.1 up until about 15 years ago. And Erik can speak to this in terms of those social security programs, Medicare, Medicaid, Social Security Trust Fund. We're at 1.6 now. South Korea is under 0.7. So most folks think we're at about 8.5 billion people globally. The UN used to think we're going to get to 10 billion and change and the world's population would peak at the end of this century. A lot of people think it's now going to peak somewhere around 9 billion and change in 20 or 30 years. And I think that's what's going to happen. So demographically, we're in a pickle because an economy grows with people and productivity. So what I would think has to happen, what I would hope would happen is technology, AI, robotics will solve for a lot of the labor force challenges. I also think and hope, right? We're all getting older. I think we all look fantastic. So good for us. But people are living longer. They're living more productive lives. And that could solve for some of that as well. But demographics are a big challenge. We're in much better shape than a lot of other countries. But we're going to be dealing with it too, for sure.
Sorry to speed you up.
Yeah, no. Sorry if I end up. There you go.
That was good. Thank you for answering questions.
Thanks.
All right. Today I'm on the Social Security Tax Torpedo. So this is something that I find even financial advisors miss. So it's important to understand what it means. The tax torpedo is the calculation of how the government chooses to make you include a portion of your Social Security or not. You don't have to include all of your Social Security income in retirement. The maximum is 85%. So in other ways, flip that around, you get 15% of your Social Security back tax-free. And I know that's not the best news because it used to be all tax-free and then they brought in taxes on it. But you get at least 15% of it tax-free. You might get more of it back tax-free. The equation is complicated and it depends on what else is going on in your income and your financial situation. So I'm going to show you the equation and we're going to talk about the Social Security tax on benefits, the Torpedo, a tool we use, and I'll give you a couple of examples, okay? So there's an easy way and there's a hard way. And I'm going to get into that real quick though. This is part of the reason that's confusing is because this language in here, generally up to 50% of benefits, however, might be up to 85% of your benefits. That's from the IRS's website. The Social Security, when you look at their website for how you know how much of your Social Security is taxable, they say things like 50% of your benefit plus any other earned income that exceeds $25,000 a year if you're single, or $32,000 if you're joint. That doesn't tell you anything either. It's super confusing, right? So I finally got to the point where the reality is it's somewhere between 0 and 85%. And I didn't mean for that to be funny. That's how bad I am with jokes. I didn't know that was one. That's just the way it is. And then I had to go through and actually build the tool like line by line on the worksheet for us internally at Capita to be able to work through the math for you. Okay, so how does it work? The easy way, 85% of benefits. So it's going to be the lesser of two calculations. This is one of them. This is by far the easiest calculation. You just take an example would be $40,000 of Social Security, multiply it by 85%, and $34,000 has to show up on your tax return. So what do we have? $6,000 that disappears from your tax return. And that happens, I think it's line 6, also we'll look at it later, on the 1040. You report the total amount, then you report only the taxable portion in the column that gets summed. You don't need to know that because either your accountant's doing that or you're doing that, and TurboTax, and it just fills it in for you. So this is the beginning of the hard way. Okay, just bear with me, okay? Stick with me. This is not easy, but I'm going to get through it fast because we only have a certain amount of time. But they take, let's go back here. They take 50% of your Social Security. Oh, and by the way, I can see some of you taking pictures. These slides are all available for you. If you'd like, there's a QR code at the end. You can just scan it and everything will be available to you, okay? And speaking of which, let's get back here. Did we have the QR code right there? If you want to quickly take a scan of that so you can ask questions. I'll leave it here for just a second. But I'll talk, okay, so while we're doing this. So they take half of your Social Security. They take all of your other income. Then they allow you a few adjustments But funny, there's like a whole list of them. It's all the Schedule 1, but they're like not student loan interest. So apparently that's the only one that they looked at and they were like, we don't want to allow that one in there. But I think that's funny. So if you go into, see, that's my kind of a joke. The other one wasn't supposed to be a joke. That was. This is where I'm all by myself on an island here. Okay. So let's keep going. 50% of Social Security, all your other income and some adjustments, that gets you to this number called provisional income. It's used nowhere else that I know of in the tax return. Provisional income, just to figure out how much of your Social Security shows up. So an example would be half of the 40,000. And then like if you're taking 30,000 from your 401k or IRA, or if you have a pension, any of that all goes in that second box. And some adjustments, not super common, but some people may be making a contribution to an IRA, some alimony, some HSA contributions. Those can reduce this a little bit. Those don't do too much. And then, well, that gets you to the $50,000 total. So this person has $40,000 of income from Social Security, $30,000 from other sources. There's $70,000 total of income, but their provisional income is $50,000. Okay, so everybody's provisional income is a little less than their regular total income. Okay, so they take, I'm going to do this real fast because you don't need to know this is our job. But they take that the hard way up top, part 1 we call it sky blue. We paid a marketing company to tell us what colors we liked. And we like sky blue. So that top color is sky blue. It's 50% of your Social Security benefits. It's either that or it's the amount over these thresholds. So you have right here, if you're a joint filer, 32,000, single filer, 25. So you take your provisional income. In this case, it was 50,000. Anything over that, you have to include 50% of it. And that's part 1. And then over the second threshold, you have to include 85% of it. That's part 2. You add part 1 and part 2 together, and that's the second calculation. This is the hard way. So let's give you an example. 50% of Social Security is 20,000 in that example. Provisional income, you can see right here, I'm clicking through. Provisional income's 50, and there's 12,000 over the first threshold, so they have to include half of that. Then so that's 6,000 total. Then 6,000 over the second threshold, 85% of that is 5,100. So I know I'm clicking through this fast. You don't have to know this math. I'm just telling you how it works. So then it's $11,000. So this, remember how before I think it was 34,000, right? 34,000 or 11,000. So although we don't like the math of the hard way, we oftentimes like the results of the hard way. And so we're glad for that, right? So anyway, it's the lesser of the two. So in this situation, they only have to include $11,000 of their $40,000 of Social Security income. So this family has $11,000 of Social Security income showing up on their return. And then they have $30,000, can't forget that $30,000 of IRA withdrawals, 401k withdrawals, and pension income, all of that. So really they have $41,000 of income to show. Remember, they had 70 total, but 41 to show. That 41, even at a standard deduction for a couple, most of the time, these folks on Social Security over 65, you get a higher standard deduction. They're going to wipe away all but maybe $9,000 of their taxable income with standard deduction. And then we're going to multiply that $8,000 or $9,000 by 10%. This family has an $800 tax bill federally and $70,000 of income. So just pause for a second there and remember when you hear the Saturday radio telling you you're going to die because of taxes, right? It's not quite like that for most retirees. Most retirees have a lower tax burden in retirement than they did while they're working. And if we optimize it and strategize around it, there's an opportunity. Okay, so it is line 6 right there. This family, so they show the $40,000 in box 6A, and then box 6B is the column with all of the lines you add up, and they only have to add in that 11,000. So that's the Social Security tax torpedo. So how do you strategize around that? Well, this is an example of that same example, adding $2,000. What happens? So if they add $2,000, it goes from $11,000 to $12,800 of their Social Security. So they didn't just add $2,000 of income when they added $2,000 of income. they added 3,700, because 2,000 from Social Security plus 1,700 additional Social Security plus the 2,000 more they withdrew from their account, right? That withdrawal from the account forces more Social Security to be included. The blue category is where the hard way is the chosen method for their calculation on Social Security. Once you get to this 85% of benefits being the lesser of the two options, that would, remember, easy calculation, but it's the maximum taxability. So once you get to the hard way, you're out of the Social Security tax torpedo. So in other words, if you add more money over here from 30,000 more to 40,000 more, it's not going to impact the portion of your Social Security that's taxable. So I'll show you a couple of examples, but I want to pause there. Do you have questions?
Is it better to pay your taxes on retirement income now while working or after retirement?
Better to pay taxes on your retirement say it one more time.
Is it better to pay your taxes on retirement income now while working or after retirement?
Gosh, there's a lot of ways this question could go. So if you're that person and you want to ask again a clarifying question, or you want to try to clarify, here's my mind. I'm hearing you wondering, thinking, are we talking about like paying taxes on money you're putting into your retirement accounts, therefore doing Roth contributions or traditional contributions? Or are we talking about working and taking Social Security and having to pay taxes on it while you're working? I'm not quite sure. But the second one, most people don't file while they're working much, especially if you're younger than full retirement age, because not only do you pay taxes on it, but if you earn too much, they'll actually pull it back. So there's a limit on how much you can earn and take in terms of Social Security. Once you reach full retirement age, that penalty goes away. And if you are doing that and you're younger than full retirement age, don't get caught up by the word penalty. It's really not a penalty, even though they call it a penalty. They're just holding it back. They're going to give it back to you at full retirement for the rest of your life. So in other words, there's a lot there, but that was a quick answer to that. But if they're talking about the Roth versus traditional, that's a unique that we did a whole hour and change on YouTube. That's the most viewed one, I think, has like 800,000 views. That is a pretty complex. I'm going to give you a couple of examples though. If they throw in if I didn't answer it with those two, then let me know. Okay. That's the Social Security tax torpedo. And then we have tools. If you guys want this, you can have this tool if you want to tinker with it. We have our own version of it for advisors, which I'm going to pull up real quick. And I know this, I'll zoom in and out. I know it's small font, but I'm going to give you a couple of examples we have a few minutes left, okay? So, if we look at this scenario one, I just threw in $45,000 of adjusted gross income and $40,000 of Social Security benefits, meaning maybe this 45 is a pension, IRA withdrawals, all those other things that just count interest income, and then they have $40,000 of Social Security benefits. Then their provisional income 65 because it's half of the 40 plus all of the 45. And then this is that funky hard way calculation, and this is the easy way calculation. So the hard way is winning in this case. They have to include 23,000 of their 40, which works out to be 60% of benefits. So oftentimes we get the question, what should I do with this 401k that I've been saving? Should I just withdraw from it as needed and when they make me take it out in my 70s? Or should I be moving it over to Roth in the meantime? And a lot of people will take the extreme approach of, I should move it all over to, in the beginning, they think, I did it wrong. I should have had everything in Roth. Or I did it wrong. I should have put everything in traditional and gotten the benefit. And most of the time, it's actually somewhere in between. Because if you look at the tax rates, this is how it works for a couple right now. I know I can change it and show you single if you want, but 10%, then 12%, then 22. That's a big jump between 12 and 22. When these current tax rates sunset, not sure, spoiler alert, that happens at the end of 2025. So 2026, all the tax rates change. It goes 10, 15, 25, 28 instead of 10, 12, 22, 24. So the question really is, can you get it out now at a lower tax rate or later at a lower tax rate? That's all you want, is which one gives you the lower tax rate. There's math behind that we can get into, but the point is, it's a really good opportunity between 12 and 22. Like, if you have space inside the 12% tax bracket, you could do conversions there. So we did in this case, $47,600 worth of Roth conversions. And that's now scenario 2 after the adjustments, right? So now they have $92,600. So instead of including 60%, they have to include 85%. And the question is it worth it? Right? It somewhat depends on what their situation is going to look like at minimum distribution age. But my question is then, how much additional income did we have to show? So we had to show $57,000 more of income, even though we only did a $47,000 conversion. $10,000 of Social Security snuck in. We accidentally, that math pulled in $10K of Social Security. So then what that means is the true cost of that conversion, even though it was inside the 12% tax bracket, was not 12%. It was 15 because of that extra 10,000 that snuck in. This is what my industry in general doesn't do very well. They don't know how to calculate the unintended consequence of the Social Security sneaking in as you add, because they look at the 12% tax bracket and they're like, great, let's fill it up. Well, this is exactly filling it up for this person. And it's okay. 15% is still probably worth it. That's the bottom line in this one. Most likely, especially if they have big pre-tax amounts. If this person has very little pre-tax money, I probably am not stressing about converting much here. But if they have $2, $3, $4 million of pre-tax money, especially, we're absolutely converting. In fact, we're probably pushing it further. And that was this scenario. So I just did another one, same starting point, but then modeled in $200,000 of conversions. This would be the person who wants to convert everything. And watch what happens if we do that real quick. I'm just going to zero out their their other income. So let's say they converted everything, and the only thing they have to show is Social Security because everything else is in Roth. They don't pay taxes again. This is that scenario. They don't have a tax bill because their Social Security disappears for the most part, and they don't even have to convert everything. They could convert most of it and not have a tax bill. So that's the other scenario that it depends on how painful it is. In this scenario, they're going to go through into the 12, and potentially into the 22 and 24% tax brackets. Their Medicare premiums are going to go up to $349 a person instead of $174. And their marginal cost of that conversion is 21% on average. So on the $200,000, they're going to pay 21% tax to get it over. Plus Medicare premiums for that year are going to be an extra $200 and change per person per month, $400 to $5,000. Okay, so they're paying an extra $5,000 in Medicare premiums as well. So that's still probably worth it to a lot of people. If they have $2 or $3 or $4 million and they think over the course of a decade they can try to wipe out their pre-tax money and get it over into a Roth and then never pay taxes again from 73 to 90. You can see how everybody's situation is a little bit different on this. But I really don't want to make you all walk away thinking, Zacc said everyone has to convert a ton. Because that's the popular thing right now. You're hearing, you gotta move. But let's take this same situation and let's add maybe they have to take another $20,000, meaning let's say this $45,000 is pension income, and so that's not going away, or it's interest income that's never going away, and the Social Security benefits are not going away. So that scenario is baked. And then their minimum, let's say they have like a $500,000 pre-tax account. Their minimum distribution is probably going to be less than $20,000 to start, and every year they make you take, just like on Medicare, they make you pay a little bit more. As you get older, they make you take out a bigger percentage. And this particular person, if they had to take out $20,000, less than a $500,000 pre-tax account, they still don't have that big of a tax burden overall to get that out every year. And it could be, just a few percentage points. I mean, basically you're adding from 60 to 85%. That one's actually fairly painful. That's a bad example. There are some, we run into a decent number of ones where it's like your bill is 10% at minimum distribution age. I don't think I would convert if you can sneak it out at 10, 15, 20, well, let's call it 10, 12, and 15 forever. Then then there's a really good argument to be made that it's okay to have some pre-tax left and sneaking it in at really low rates. Especially, think about it, you'll have about a $30,000 standard deduction. Now that will change in the future, but right now we have about a $30,000 standard deduction, which means you get the first $30,000 tax-free. So if you eliminate all sources of taxable income because you paid taxes on it, you missed an opportunity to get $30,000 for the rest of your life, totally tax-free. So, okay, so that gets you to different strategies. We talked about these. Let's talk quickly about like a qualified charitable distribution. So we have a lot of folks here who give to charities, whether it be through hospitals, schools, churches, and like tithing. If you are over 70 and a half and you take money out of your IRA and send it directly to the charity, you don't put it in your bank and then move it to the charity that way. You skip the bank, you go straight from IRA to charity. You don't have to report that income on your tax return. It's called a qualified charitable distribution. So it's super slick. And so people who are currently taking withdrawals from their accounts and then paying, for example, a tithing of $10,000 every year, basically at 70 and a half, you stop doing that. And you start sending it directly over and you stop the withdrawal from your account, which reduces your income by $10,000, which also will likely, if you're in the tax torpedo, pull some of the taxable portion of your Social Security back too. So you might reduce your income by 10, but from not doing the withdrawal, it may actually reduce the taxable portion by 12 to 15. Okay, so all of this is actually the basic version, this tool that we use. And then beyond that, we have a software, we talked about it before, we can throw your tax return into it. It will automatically read it, provide 12 to 15 recommendations plus scenarios that we can then mock up and adapt. And so that's something that as a Capita client, you have available to you. Not everybody wants us to go through that every year, but we're happy to. So if you want to send us your 1040, don't just send us the couple pages, talk to your advisor and send the whole package because the software reads all the schedules as well. And we're happy to analyze it, provide you the one-page report with the recommendations. And then if specifically you're trying to figure out something like, what if I take more income right now? What if I convert? What if I do this different charitable strategy? What if I sell some large long-term capital gains? Or really the nice thing you want to know is like, how much room do I have in the different brackets? We can do all that work for you. Okay, so just in general, let's get to any questions? Hold on, I got to go back. Okay, so that QR code should get you access to a landing page with these slides. I think we may need to, I wonder if they're already up there. Shannon, are we going to? Okay, so maybe scan it, leave it in your Safari for 24 hours. Give us a minute to make sure, because I actually made a couple little adaptations to the slides and we'll get the updated version in there. And mostly, this has been a wonderful and wild ride being part of Capita. I started when there were 5 employees and there were only a few advisors, and it is amazing. There were 300 clients and now we have 2,300 roughly. And it has been so fun. It has been so fun. But we do these things on these nights like this because 1, we enjoy it, of course, but 2, we want to say thank you and we want to provide the opportunity for you guys to learn whatever you guys want to learn. So I'll say this, every 6 months, I'm like, what might they want to know? So if you have an idea as to what you want us to talk about in 6 months, send it to me. We'll for sure take it into consideration. And mostly, thank you. Thank you for coming.